The second part of the not-for-profit organization, class 12th, that is income and expenditure account. The non-profit organizations who are not working for profit, they prepare receipt and payment account and income and expenditure account. So what is income and expenditure account? Basically, the role of non-trading firm is to provide service to its members, but in order to do so, it requires to earn some revenue and generate certain surplus. Or when a non-profit firm does so it needs to prepare an income and expenditure account. So income and expenditure account is prepared by NPOs for ascertaining their surplus or deficit. It is prepared as a part of final accounts and is equivalent to the profit and loss account, which is prepared by the trading organizations. So the income and expenditure account is equivalent to the profit and loss account prepared by the trading organizations. So in short, income expenditure account helps a non-profit organization to find out the surplus or deficit during a particular year. Now, what is surplus or deficit? Surplus is equal to the difference between income and the expenditure of the non-trading concern, and deficit is the difference between the expenditure and income of the non-trading concern. Now, the characteristics or features of income and expenditure account. Number one, income expenditure account is prepared by non-trading organizations or NPOs and is much like profit and loss account, which is prepared by the trading organizations. Number two, it is prepared at the end of the accounting year. Number three, it strictly follows the principles and the rules of double entry system. Number 4. The fourth characteristic of income and expenditure account is that it includes only items of revenue nature. The capital nature items are not included in the income and expenditure account. And finally, it determines the surplus or the deficit earned by the non-profit organization during a year, and this surplus or deficit is transferred to the capital fund. And what is capital fund? We will be learning further in the chapter. So the surplus or the deficit is transferred to the capital fund. Steps for preparing the income and expenditure account. First of all, obtain the receipt payment account of the non-trading organization. That is, the receipt payment account which has been prepared for the non-trading concern. It is required for preparing the income and expenditure account. Number 2, the opening and closing balances of cash that are given in the receipt and payment account has to be ignored. And 3, then remove all the payments of the previous year, of the future year, and the capital payments of the current year. Only revenue items are to be recorded. Remove all the receipts of previous year, future year, and the capital revenues of the current year. And the last one is include all the current year incomes and expenditures, including depreciation on fixed assets. Now comes the format of income and expenditure account. Firstly, we will mention the name of the club, institution, or the NPO whose income and expenditure account we are preparing. Then the name of the account for the year ending, so and so. We have to keep in mind this current year because we have to include all the expenditures and income concerning to this current year, may be outstanding or received in advance. Like any other account, income and expenditure account has two sides, debit and credit. Debit side represents the expenditure, credit side represents the income. The main sources of income of our NPO are subscriptions, membership fees, entrance fees, rent, donations. Main sources of expenditure, the rent paid by the club, or taxes, then newspapers, stationery, then depreciation on its fixed assets, audit fees, etc. You can see the details of expenditure and income in the notes provided along with the video. Now, if this income side exceeds the expenditure side, the difference is known as surplus, or it is known as the excess of income over expenditure, which is transferred to the capital fund. If the expenditure side exceeds the income side, the difference is known as deficit, or the excess of expenditure over income, which is also transferred to the capital fund.